Hello, we're going to walk through short exercise 510. This exercise doesn't take very long and it's not too bad. During 2013, the company completed these transactions. We have a list of 4 transactions and we have to write the journal entries for these transactions. These are good journal entries to put on your reference sheet. Let's start with number 1. Number 1, sales revenue on account, $1,030,000. Let's look at what we do. So for number 1, we're going to debit accounts receivable. We made sales on account. Remember, when we see the words on account, that means accounts receivable or accounts payable. Accounts payable are for things that we buy. Accounts receivable is for things that we sell. So this is items we're selling. So we're going to debit accounts receivable, which is an asset, and we're going to credit sales revenue for $1,030,000. We did this journal entry also on Tuesday, and we always debit accounts receivable and we credit sales revenue when we have a sale on account. The next entry down, collections on account. This is when we're getting cash. So we're going to be debiting cash because cash is increasing, and we're going to credit accounts receivable because people are paying off some of what they owe us. So we're going to reduce that asset, accounts receivable here. Now on to the third item down. The third item down, write-offs of uncollectible accounts. This is where we know some accounts are bad. They have declared bankruptcy, or for whatever reason, we know they're not going to pay us off. They're not going to pay us back. These are specific accounts. So that word write-off means we're writing off these specific accounts. That's very important. Write down write-off. This is the journal entry for a write-off. We debit allowance for uncollectible accounts. We credit accounts receivable. So this is always going to be what we're doing. We're reversing these accounts out of our accounts receivable. We're saying we're never going to get them. And these are specific accounts that have gone bankrupt. Finally, entry 4, uncollectible account expense. Now these are for our current sales. Some of them are going to go bad, but we don't know which ones. So this is a general recognizing uncollectible accounts expense the same period that we make the sale. But we don't know which ones. We don't know the specific accounts. If we did, we wouldn't sell to them, but we don't. So we make this estimation. So we're going to debit uncollectible account expense or bad debt expense, and it's 2% of sales revenue. So we'll do 2% times the $1,030,000. And we will credit allowance for uncollectible accounts. Again, allowance for uncollectible accounts is a contra asset. It has a normal credit balance, so it will offset accounts receivable. And that's it on this exercise.